Welcome to the Broken Pie Chart Podcast, episode 291. I'm your host, Derek Moore. Back with me by popular demand, or some sort of demand, supply and demand, is my semi-permanent co-host, Jay Pestrichelli.
Somebody demanded it. It might have been you that demanded it, Derek.
Well, we give the listeners what they want. They want us both on here. Yeah. They want us arguing and debating and coming up with different points of view. But look, another Jay is more important than you this week. Jay Powell, he did it. He really did it. 50 basis points. Take that, market. You happy?
It wasn't at first. It seemed like it took a day to digest it. I think it took the international markets to really digest it. But he moved more than we thought, or at least moved more than you and I thought. But market doesn't seem to hate it. The initial reaction was up, then down, and closed down a little that day. But the next day, we came into the office, turned on the machines, and boom, nice gap up, really big gap up, and the market kind of held it all day. Little sell off today, but really, market seemed to like that and the future of what it implies.
You know, the thing that we talked about coming into the meeting, and I spoke about it last week on the show without you, and nobody could debate me, so I just got to say whatever the heck I wanted.
You won every argument.
Yep, I was 100% the winner. What wasn't 100%, though, was the 50 basis point cut. Coming into the meeting, and you and I talked about this right before the meeting, and I think we talked about it in our investment community meeting Monday. There was a 61% probability based upon the Fed funds futures of a 50 basis point cut. This is the first time I've seen that coming into a meeting, this close to a meeting, it not sort of navigating to 100% to something.
Yeah, the market really didn't know.
No.
Right? There still was a debate all the way up into the end. Is it going to be 50? And it was certainly leaning to the 50, but there was still, a third, 40%, 35% chance that you were going to only get one. And normally, by the time the meeting comes, the market, everybody's in pretty good agreement on what's expected. It's been kind of hinted. It's been insinuated. The market's already positioned itself. Somebody lost money. Some people lost money on that one.
Yes, not us necessarily.
Not us, though. Sorry, that's true.
No, there are people who are betting against that much of a move, and those are different types of markets. I don't know. I mean, it really is the first time, and I don't know if Powell. They've been really good about messaging. They didn't message a 50 basis point cut. I think they left the door open. What was interesting, though, is I feel like the market was like, wait, is this good? Oh, no, things must be bad if they're doing this. And then, like you said, the next day, the market
really wasn't until the press conference, and I didn't watch. Sometimes I'll be able to watch the presser and the market reaction based on what he says. But it was really the presser that, caused a little reversal, because up until he started speaking, it was up.
I mean, I give him credit for going in front of those reporters and answering the same question asked 30 different ways. Like, I turned it on.
I have a 7-part question. They're like, nope, just stop. You got one.
I have a 78-part question first. Yeah, and they ask him all these different things. And I give him credit for being up there. And remember, they didn't used to do press conferences. The Greenspan Fed, no press conference, nothing. You just got it on the... what we used to call it, the squawk box on our desk. It would come out, somebody would come on and say, they cut or raised 25 basis points.
Yeah, well, what they found was like the big moves happened when there was a press conference, and the press conference was a leading indicator. So they just decided okay. We're just going to do a presser for all these things. That way you can't read into it.
That's right, because if it was even odd or if it was every other meeting, it's like, they're not going to do it without the presser. And then if they announce a presser, then they're telling everyone they did it. But all right, so I guess let's start here, and then I want to go back to some of the predictions by the big investment banks and see how right or how wrong they've been. Jay, there's some data on, who is this from? Ryan Dietrich, on Twitter. And he posted this chart and he said, yes, the Fed has cut near all-time highs, and the bulls loved it. S&P returns after Fed cuts within 2% of an all-time high. I believe we were about 0.5%, 0.58% away from the all-time high. Of course, we made a new all-time high yesterday. So I don't know, Jay. I mean, look at this, and you can kind of comment on some of these numbers. It seems positive over the long run. Short term, maybe some volatility, but I don't know.
Yeah, well, if history is any indicator, it's you should buy because the market is higher every time a year later when the Fed cuts at or near an all-time high, right? The average appreciation of this list is 13.9%. The median is 9.8. So, but there's no negatives. There's not a negative scenario.
1 year later,
this one could be negative, right? But there are a few where it's only like a +2, +3.
Mm-hmm.
I think I see. But look, there's a lot of double digits, right? 90, 85. The market was up a year later, 22%. 86, the market was up 28% a year later. Actually, there's one here where it cut strange. Oh, they might have cut multiple times in the same year. Got it. Yeah, 86, even if after they cut at near an all-time high in August of 86, the market was up 33%, although we all know what happened a year later in 1987. But that's okay. Leading up to it, all-time highs, 30% higher. More recently, your favorites in here, Derek, 1995, market was up 21% a year later after the first cut. So generally, it feels pretty bullish. By the way, it's not all positive numbers on here, right? Certainly like the 1 month, 3 months, 6 months, there's some negatives in here. So you might have a little chop along the way. Most famously, it looks like 1990, they cut, and then next month down 8, 3 months later down 19, 6 months later down 14. But the year ended up kind of flat.
But that was a recession year. That was the Gulf War recession.
Yeah, and that's an example of why they were cutting to get out of a recession. Yep, exactly.
That is interesting. So the market was within an all-time high, and they were cutting, and a recession was coming. So the market got that wrong.
Yeah, because you shouldn't have been at an all-time high going.
Shouldn't have been, yeah. So I think the takeaway from this is, and I'm smiling, I'm using air quotes, as long as we don't have a recession, history tells us the market is up. And the good thing about saying that is market's up most years. And over time, the market never makes a new all-time low. It only makes new all-time highs, Jay.
That's true.
It's pretty prescient, right? It's like to make a new all-time low, it would have to go to zero.
Price, right? I guess. I don't know. I guess unless you're Jon Snow, but we could leave that.
Do you know what I'm saying? Like you'd have to go below zero on the value of the market to make a new all-time low.
Yes, but it'd be pretty bad if we even went, 50% down, right? So that's not a bad scenario.
Well, this is why we hedge. We buy, we hedge. If you want to know more about that, derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. Yeah, I mean, and
can I bring up the hedging thing for a second,
yes,
Derek, just for a minute? So, like, we have clients, and the people that we talk to, right? Because they're like, you tell me don't time the market, yet you're in there timing your hedges, right? And I'd like to explain a little bit of the difference. So, the timing of the hedges for us, it's fairly rigorous discipline. There's rules, right? When a hedge isn't going to be helpful anymore, it's time to put a new one on, right? There's certain option data points that we use, but the risk of timing the entry and the exit on the market is so much worse than risking the timing and exit of a hedge, right? Generally, right, when we hedge the market, what's it cost us? 2.5%, 3%, 4%, right? Depending on what's going on in volatility.
Yeah.
So if you get that wrong, it just means you spent the 2% a little early or you didn't spend it soon enough. The flip side of being in and out of the market, you could miss, 10% swings in a month and 2 months fairly easily, right? And it's even worse if you get out and then you don't get back in, right? That's the whole thing. So I feel like, I don't know if you have a comment on this, but like the amount of, penalty for being wrong on when you decide to roll your hedges is very, very different than the penalty for if you decided to be all in or all out.
And part of the reason of being hedged is that you can emotionally stay invested at all times in the market for the very point you just made. Like imagine if somebody said, I don't know about this Fed decision. I'm going to let the dust settle. Yeah, you missed out 2%, almost 2% the next day. Like who saw that coming? No one. No one.
Especially not after the way the market reacted the day of.
No, or even worse. August 5th, near the lows of the day. Oh, this could get much worse. I'm going to sell.
I mean, somebody sold at the low of the day on August 5th.
Somebody did.
Yeah.
Somebody bought. Somebody bought too.
I know somebody that bought.
I don't. What's that, Jay?
I said I know somebody that bought that got more along the market on August 5th.
Can we mention that? I don't know if we can mention it.
Okay.
I don't know if we can mention it. We have a quantitative strategy that is tactical, that at times can go short, and at times can go long. At times can take a little bit of extra long or leverage. And you can email me if you want to know more about that. But we'll leave it there.
Leave it there.
All right, Jay. So I think the takeaway here is that, barring a recession, I think this is positive for the markets. Like, everybody wanted this. And don't you think there's money still on the sidelines? It's like, oh yeah. And I don't know why they'd still be on the sidelines. Like, oh, what am I going to wait for a Fed rate cut?
Oh, they're waiting for the election, Derek.
Well, we're going to get to the election
later. You asked what they're waiting for. They weren't waiting for this. So this is, this is generally a good thing, right? You saw the data, so the numbers tell you it's a good thing. Fundamentally, what's it mean? I don't think all of a sudden people are going to take out a bunch of loans right away because of this.
What about housing? Doesn't this unlock the housing market a little bit? Maybe not enough.
It starts, and you have to like what would we expect that number to be? Another 100 bips? Well, guess what? He's not going to cut 150 at once. I actually think it's a very interesting signal. Look, it was clear he had the clearance from the market because the market had kind of given him a wide berth on whether to cut one or two times. Could have cut once, could have cut two more times, two and just see how it goes. But to take the plunge and cut twice out of the gate, yes, he could decide to cut no more times. I think that'd be a real weird signal. But he's told you he's serious about, more committed to cutting than maybe we thought before. So I think the market takes that as a good thing. And does it weaken the dollar? That's good for the market. Yeah, right, because rates are lower, all that kind of stuff. So generally there's a lot of good stuff that comes from lowering rates. There's an old adage, I didn't make this up, you don't fight the Fed. And if you try to fight the Fed,
is that new?
Is
that a new one, Jay? Is that
it is. I think people have heard that before.
Yes.
Like if you fought the Fed in 2022, you paid dearly. And if you follow that same logic, if you try to fight this Fed here in 2024, 2025, you might have the same fate. You do not fight the Fed. The Fed's telling you which way he wants to push the market. Not the market, the interest rate markets, which then flows over to stock market. I don't know how much Jay Powell cares about the equity markets, certainly not as much as we do, but he's aware. He's certainly aware, right, of what happens there.
Well, if he didn't care, they wouldn't have done the emergency rate cut when they did it in 2020. He wouldn't have lowered rates in 19.
I don't know if that was a stock market thing.
I think it was 18 to 19. I think it was.
Yeah. Okay.
18. Remember, he raised the interest rates that was the December, the Christmas Eve bottom.
That was Q4 of 18. Right?
Q4 of 18.
And that's where we had we tried to talk ourselves into a recession. We didn't have one, but the market talked itself into fearing a recession.
But they were raising rates back then. I mean, there wasn't a lot, but then they cut in 19. So I think Jay Powell, the market affected them at that point. They were like, oh, we may break something here and we don't want to be on the hook for it. We'll see. So where do we go from here? It's November meeting, Jay. Has the implied Fed funds rate. They have a cut and a half, which means there's a 51% probability of 50 basis points coming into this meeting. More recently, it was 61%. So the market doesn't know. By the December meeting, it's almost 3 cuts from here. And 3 cuts would be 75 basis points. So like if the Fed funds futures are correct, by the end of the year, you could see the implied Fed funds rate go down to 4.086. Right now, it's 4.83, the effective rate. So, all right, that's another 50 and a 25. I don't know.
If that happens, it seems like the market will like that. That's probably the expected reaction there.
Jay Powell, last thing on this. I want to move forward. I'm getting tired of talking about the Fed, but I will say I think Jay Powell. Remember when he's like, "We're not cutting. We're not cutting." Like he got mad at the Jackson Hole meeting. I think this was his way of saying we're cutting. Like, no, we're cutting. This is his communication. 50 basis points. Yeah, you didn't think we're serious about cutting? We're cutting.
We're cutting.
We're cutting.
How do you think inflation feels about that?
I still don't think what they do matters. But on the periphery, if this does help the housing market, it could cause the owner's equivalent rent and rents. I think rents would be helped because your cap costs and all that stuff with when you have leverage on a building. But that's potentially it could raise the owner's equivalent rent. I don't know. I'll let you know when it happens. How about that?
Yeah. Okay. All right. 2024.
So Sam Rowe had tweeted this out. Ticker, he writes a newsletter, but I kind of follow what he does sometimes. He posted a screenshot of Wall Street's 2024 S&P 500 year-end targets. This was as of December 3rd of 2023. Jay, where do we close today?
Today, the S&P closed at 5702.
Okay, 5702. So that's not 4200.
No, that's not.
JP Morgan had that. So not 4200.
JP Morgan closed it. By the way, I heard Jamie Dimon today on TV like, well, I'm not sure if we're going to have a soft landing or not. Like, come on, dude. We've been through how many years do we have to get through this before you realize things are not terrible in the economy? He's so stuck on, historically what an inverted curve does or indicates in a market. Like, I don't know. All
right. So I've been thinking about this a little bit. And normally the inverted curve means you are lending long and paying short. But remember I was making fun of you, or not making fun of you, but saying, what are you getting, like a basis point, like 0.01%
in my checking account? Yes.
Are they really paying short rates that are higher? It's an interesting question to ask.
He's not actually paying, and I have a Chase account. Yeah. He's not paying me 5% for sitting in cash. So you're right. So they've adjusted. So look, they've been the
But do you think Jamie Dimon is influencing? I don't know. Is it Wilson, the analyst? I could be totally wrong on that. The JP Morgan analyst.
I mean, you can't come out and be like 6,000. Meanwhile, Jamie Dimon's like, everybody better brace. I don't think the market's ready for this.
Yeah.
Look, he absolutely influences the market. I will never forget. It was 2016 when there was all this fear, early 2016, about oil prices and it impacting high yield, right? Mm-hmm. And he came out and said, I think high yield's a pretty good buy right now. That was it. That was the market just turned around almost to the minute when he said that. So he absolutely can impact the market. It just seems to be on the wrong side of this one for at least a year.
Well, they weren't the only ones. So 4,500 Morgan Stanley, not 5,700. 4,600 UBS, 4,625 Wells Fargo, 4,700 Goldman Sachs, 4,750 Societe Generale, 4,800 Barclays, 5,000 B of A, 5,100 BMO, Deutsche Bank, so both of those, and 5,500 Capital Economics. And I will tell you, Ed Yardini, I remember him going on CNBC, and I think it was in Barron's. I think he called for 6,000 this year. He's not listed here. Those are not 5,700. So, and in fairness, you and I do a show at the end of the year every year, and we have our predictions. Let's see how bad we did, Jay. So I have the S&P year end at 5,500. You had 5,200. So
I do.
Not 4,200. You're not.
Look, we just touched for 5,200, right? But listen, that's true. None of these are. Yeah, we're not.
Yeah, we don't trade off these. It's just really for.
Just for.
Because you and I make fun of people making the predictions. We think it's silly. because they're just going to raise them. Like, I'll bet you if you look at any one of their current year-end targets, JP Morgan's not like, oh yeah, we're still going to go to 4,200. They're probably like at 5,600 or something.
Yeah. So this is an older prediction, right?
Yeah,
so this
of course.
We made our predictions. All right. Well, we lean towards the higher end. That's how the market seems to be.
I wouldn't say that though. I think the year before, I was wrong the year before. I thought it'd be worse, but all right. Well, do I really want to talk about the dot plots?
Can we skip that?
Let's skip it. They're always wrong.
They're always wrong.
They really are. The Fed is awful at this. I always remind people, James Bullard, who is no longer on the Fed, he once did not submit his prediction, because he said, we're really not that good at this. He just left it off one time in sort of protest. All right. What else do we want to talk about here?
Well, let's talk about how often we have all-time highs, because I think this is a very interesting period that we're in right now, and this year for sure.
Yeah, I found this from All-Star Charts on Twitter, and one of the interesting things was you and I, a couple weeks ago, we pointed out that September is historically probably the worst month, historically. Of course, this month we just made a new all-time high. September does have the lowest number of all-time highs. I think this is going back to 1950. The month, by the way, in case you're wondering, with the most all-time highs is November. And so November and July and January. So there you go. The other piece on this, we've had now 39 all-time highs in 24. Not bad, Jay.
I love it. It's good. Highs are good.
It's fantastic.
Yeah.
I was looking to see if 95 at 39, 96 at 39. I was hoping for the 95 equivalent.
Oh, you're looking for that. Well,
yeah.
The year's not over.
That's true. Are you calling for more new time highs? No, more new all-time highs, Jay, if I can speak correctly.
Look, when we look at the data, all-time highs beget more all-time highs. We've talked about this before.
Yes.
Historically, when you hit an all-time high, within 30 days, there's a 60% chance you're hitting new highs in excess of 3%.
Right.
This once you get to that high, generally, historically, when you look at the math here, you have another high, and those highs continue to go. So,
that's right.
I think if history tells us anything, all-time highs beget more highs. So yes, I would say yes, more highs are coming.
Well, remember though, I mean, it seems a big deal to get a new all-time high, but it's like markets trend. The trend is your friend until it ends, or there's a trend until it's not a trend. And markets do have these runs. The other thing I would say is that to make another all-time high Monday, we don't have to be up that much. It's not like, we're at the bottom of, it's March of 2009. We got to get back up to the old 2007 highs, which are 45% higher or whatever the heck they were. Like, it's pretty easy to get an all-time high when you're right around all-time highs. And Jay, I know you've run numbers. What are we within an all-time high? We're within what? 3% of an all-time high. How much?
I wish I had that number off the top of my head, but it's something like 38%.
Yeah. Yeah. It's more often than people think.
Than you would think. Yeah. Yeah. I mean, we only need to go up 10 points and close 10 points up on Monday to get 10 or 12 points to get a new all-time high. Like, it's not much. It's 20 bips.
Yeah. 0.2% gets you a new all-time high. That's it. That's it. The other interesting thing I found, I wish I wrote down, I think this might be from All-Star Charts, but this could be somebody else. Number of S&P 500 all-time highs per month. So we just talked about how September doesn't have that many. We just did an all-time high in September. Jay, you know what other year had a lot of all-time highs in September?
Let me guess. Was it 1995? 95.
There you go. 95. And for anyone who's new to listening to us, and if you are, thank you. 95, 96, 94, 95, 96. But 94, 95 has been the closest corollary to, in my opinion, to 23, 24. And during that time, we didn't have a recession. We had the yield curve did not invert from memory, but not only did we have all-time highs after they just cut a little bit, rates stayed higher for longer. I'm not convinced that rates are going to go down to 2.5% or 3% like everybody else is. I think that may be a miscalculation unless we have problems in the economy. But anyway,
well, listen, in all fairness, you have been making that comparison now for at least a year.
At least
setting up for this. Yeah.
Yeah. And I don't want you to talk about all the stuff I said that didn't come true, but for stuff I'm right about, we should continue to talk about it, Jay.
Because you get to come up with the show topics. Sure.
That's right.
All right.
All right. We're done with all-time highs. Let's go to the VIX and volatility. All right. So, Jay, October, over the next 3 months, the October future now is lower than it has been. You might remember it was above 20 for most of the year. In fact, I think it edged towards 21. It's down below 18. The spot VIX today, the one you see on CNBC, what did that close? Just under 16, right around 16?
Looks like 15.8, I think I got. Yep.
15.8. Okay.
Yeah. No, sorry. I could be wrong about that. It's about 16.
Okay. So VIX futures for October, right below 18. So the reason I bring this up is I would say volatility, it's not 12, it's not 13, but there is a difference between what we call the spot VIX, the one you see on CNBC that you can't trade, and the future. And right now there's about, call it a 200 basis point or 2% difference. Jay, what typically happens when we have a spot and a future? Does the future come to the spot or the spot come to the future?
The future comes to the spot, right? The spot is the actual mat. That's the number. The future is, got that kind of leaned higher, or, if it's overbought, then, the lean lower. So there's more of a predictive nature. I'm not going to say emotional nature to it, but there's a predictive nature to the future. So the future will track to the spot itself.
Yes.
Eventually. Even if it takes all month, it'll get there.
Could be the last day.
Could be pretty regularly.
And by the way, if the spot goes to 30, I wouldn't expect the future to go to 30, but eventually at expiration, they'll be right around each other.
Not right away. No,
not right away.
We like to say the futures can be a little lazy because of the whole reversion to the mean, right? Something pops up really high. Everyone would say, all right, give it a minute, right? And so the futures kind of have that laziness to their pricing. However, if it persists, they can end up getting more aggressive on the future, right? We've seen that happen before, where you have kind of periods of higher volatility, few spikes. The market then kind of resets its expectation of where the spot may close. And you'll see the futures kind of be a little more, I'll say, sensitive or reactionary to the move in the spot VIX. But with the spot we're in right now, no pun intended on spot.
Oh, I like that.
I didn't mean it. Take it back. It's really cheesy. We're in this VIX at 16. Futures are probably going to be a little lazy around this one. But predicting a chance, right? I think this is where you're going for a spike.
I think the difference there between the spot and the future, it's not huge, but there's still a gap. What's interesting to me is, the October future, everyone's like, oh yeah, there's the election is really, there's a kink. There's not, though. I mean, the VIX future for October expires like the 16th, I think? 16th of the month. So that is prior to the election. And I don't know if November, but November's lower than October right now. So yeah, I mean, I think maybe it was just pricing in that there'd be volatility in September. The more they think about it, the more I think there's not really much election volatility priced in.
Yeah, so I'm going to go a little contrarian from what you and I had said before, not against what you said, but what you and I had said in the past. We said, look, the market can be volatile around the election. You see it in the October, Novembers. And it was kind of the trade that everybody talked about, which was, hey, look, stay in the market. Things are pretty good. The Fed may cut rates. You want that, wind in your sails, and then you could take some risk off come, September, right? It's because we expect that bad month, September, October. We've said that more than once here. And I think we got it early. Like, as I'm starting to think about it, that's the crowded trade now. I think there's, I'm going to go out on a limb and say we've had the volatility. We saw the August dip. We saw a little sell-off into the first week of September. Market shook that right off, and now we hit a new high. Vol doesn't look like there's any kink in the curve anymore. There's an argument to be made here that the vol's done, and while November typically has, the most amount of new highs, we may get it early. We may get it early leading into the election, and it may actually end up being kind of the opposite of what we thought, what typically can happen in a September, October, November period during an election year. So I'm going to go contrarian on this and say, you know what, keep your hedges, roll your hedges, but it's not the time to get out of the market if you think the volatility is already done. And
I think part of the reason too is, we've done some analysis. I'm going to send this to you real quick because we didn't plan on talking about it. But it's the idea of should the election actually cause volatility? And the answer is maybe. But the numbers don't add up over the long term. And the numbers don't add up because I went back and I looked at 102 years of the different constructs, whether it's a Republican president, Senate, and House, all Dems, some sort of mix and match. And while some of the constructs haven't happened that much, all Republicans has happened 15 out of 102 years. That's 14.7% of the time. The average, not the compounded growth rate, the average return is about 16.57%. You look at Democrats, all three. That's happened 36 times, 35.3%. There was a period, a very, very long period, where you had all Democrat, President, Senate, and House, from early 30s up until really, it was a number of years. It was something like 20, 30 years in a row, I think, at one point or thereabouts. But that's about 13.47%, bigger sample size. What we have right now, we have Democrat, Republican. That's only happened 6 times, 5.9% of the time. But that one's 18.25%. Of all the different constructs, low sample size, but that's been the highest return. The point of bringing this up again is, I know people get bent out of shape about the election. They really shouldn't. It doesn't matter in the long run. And in fact, Jay, the advice I would give anyone, including you, if you ever want to run for president at a time when you take office at the bottom of a recession. It's good advice. You'll get the credit for everything.
Yeah. I think we saw a little, you got it. I think that's a good way to do it. By the way, there have been plenty of folks that have thought I should run for president. I think that's the worst idea in the history of presidential.
Who would want to do that?
I don't know. I know we don't love, the candidates. There's no loved candidates right now, it feels, right? I shouldn't say that. There's just a lot of questions about our candidates, right? There's no obvious picks. Maybe that's the way to say it, right? We have, and I'm really going to try to avoid any landmines, but I would say
here. Let me help you out. Before the swap, Biden and Harris. What I was telling people is you've had 4 years of Trump and you had 4 years of Biden. And by the way, Biden Harris, you'd probably say she's probably going to be pretty similar to Biden, or maybe a little more left, maybe a little different. I don't know. But we've had these constructs, Jay. This isn't anything new.
Yeah. So I think, that's it. And all I'm talking about is the next 3 months. This data that you have here is full year data, right?
It's years.
Yeah, years. So look, yes, I would agree. It doesn't matter. We were talking about volatility, and that's why we led into this. And maybe there's not election volatility here, but I would tell you that, when you read the tea leaves, yes, volatility. We have an all-time high, but we don't have a 12 or 13 VIX. We have a 16. I think it was just 18. Right. Mm-hmm. So this is, the market is still showing some concern yet. It's definitely not the all clear. But I think that's the crowded trade right now. I guess that's all I'm saying. Right. But if you're making investment decisions based on the election, make the decision to either tighten up your hedge or not. try not to make the decision of go to cash or stay invested, right? It's just how tight your hedges are or not. It's a scenario that if you're wrong and you over tightened and you didn't need it, then you probably spent an extra 1 or 2%. If you're right, you're going to be thankful. And that's the way for us. That's the way we go. So there's folks that I've had conversations with in the last 2 weeks that they have an opinion. I'm not going to convince them one way or not. We're not giving advice on what's going to happen when the election is over. But their opinion was, I'm concerned. And we said, okay, so let's tighten up your hedges, right? Did those trades today. It's just one of those things that's the way to deal with it, as opposed to saying, let's go to cash. No,
I agree. It's, Who would want to be president, by the way?
I don't want
Can you
that.
imagine that?
Nope.
And I mean, to use a quote from the show Succession, these are not serious people, politicians. I have a very low view of politicians.
I think he said you are not serious people. I think he was accusing his children of not being serious.
Yeah, well, this is me talking to the politicians.
Oh, you're adopting it.
You are not serious people. Yes, me to the politicians. And to borrow from the usual suspects, the greatest trick that ever was played was these people making everyone else think that they are vitally important. All right, let's move on from politics. Back to the VIX, though.
That went up pretty good.
What's that? Did I mess it up?
That's all right. Well, you got your point across.
Yeah, maybe.
I'm just trying to cause a little conflict here.
That's fine. We can cause conflict.
Get your quotes right.
All right. So back to the markets, VIX volatility. I would say I'm not sure it's the election volatility that's in the VIX. I feel like we're at the turn, and until the turn, we're far enough into the turn. The turn meaning we're now lowering rates. Some things are happening in the markets. The dollar is readjusting. Interest rates are readjusting. By the way, I will tell you, I think another credit trade is the idea of getting long bond duration. Even if rates go down to 3%, which some of the futures are saying, does that mean that the 30-year goes to 3%? Really?
Yeah.
Wouldn't the 30-year? I mean, can we play a little contrarian corner, by the way?
Oh,
we haven't played that in a while.
Sure, we haven't been in the corner.
Do you buy or sell, and I'm not asking for your opinion, I'm saying this metaphorically. Do you buy or sell TIPS bonds, TIPS, Treasury Inflation Protected Securities?
Inflation protected, which
or if you knew
very much
Fed was going to be lowering rates and inflation was coming down, would you be buying those or selling those? I'm not, again, proverbial you.
Yeah, well, all right. So look, I mean, the concept of TIPS is they're designed to help offset inflation, which can hurt bond prices, right? So, if you think inflation's coming down, so rates are coming down, yeah, you should buy those because rates going down are good for bonds, no?
But inflation's coming down. Wouldn't you buy these when inflation's going up?
Well, look, we're in the corner, so I just made the rate more important because in 2022, if you thought, with all this inflation, let me buy TIPS, you got smoked because rates went up so much it didn't matter that you had the inflation protection on.
Yeah. If you look at, so this might surprise you, look at, there's a couple ETFs, and I wouldn't quite prepare for this, but
it's all right. I know how to look at a chart. Let's take a look.
VTIP, that's a Vanguard short-term TIPS. That looks like...
That's pretty bullish.
Yeah, people can't see the chart, but the low is 46.70. That was in October. It's 49.34. That's like 10% higher.
Yeah. By the way, that same ETF at the end of 2021 was trading at 51. So you took all of 22. It ran from 51 all the way down to, is a weird thing on the chart. I guess there's a large distribution, but all the way down to 46, right? This is a bond, right? A short-term bond. So to have a short-term bond portfolio index, right? Then it's a bond fund. I shouldn't say it's an individual bond. It's a bond fund. Go from 51 down to 46. That's a 10% decline, right? And you are not back up yet. So on the price of the price of the ETF. So I'm sure there's distributions and those kinds of things with those. But look, it's on the rise. Yeah, rates are coming down. Bonds are going to go up, Derek. I feel like that right now is prevalent.
This was the obvious trade. Remember, everyone's like, oh yeah, we got to buy gold and we got to buy TIPS bonds or TIPS bond ETFs. once inflation started going up. And you're right. They have duration, though. Interest rates go up, they still cause bonds to go down, even if they're getting the benefit of that treasury or the inflation increase. So yeah, like who would have thought Fed's going to lower rates, inflation coming down? I'll buy the treasury bonds, the TIPS bonds
coming down. That inflation protection should be damaging, but it's not. You mentioned gold. There's something that hit an all-time high today.
Yeah. So to me, is that an indication that the market is seeing looser monetary policy, looser money? And so it's gold?
It's because Costco made gold bars available again.
Oh, did they? Is it on there?
They did. They're sold out. By the way, but now Walmart is selling gold bars.
Walmart has, I got to look at this.
I bought a gold bar from Walmart. Full disclosure.
Gold bar. You don't want one.
I did. I bought one.
Oh, you bought one? Okay.
I bought an ounce. It's not a 100-ounce bar like you see in the movies. I bought an ounce from Walmart. Ounce of gold from Walmart. I just felt like I had to. I was like, really? Gold at Walmart? I'm buying one of those.
Is this, they have a precious metals shop. Look at this.
Look at that.
They got what is this
here? A little ad hoc here, but just thought you brought up gold. I brought up gold. Thought I'd share that I bought.
I told you I may buy one of these.
Why not?
Yeah.
It is.
Can I get the one with the kangaroo on it?
We're going to see how the delivery goes.
The kangaroo.
Card.
Do you see the one that got a kangaroo on it? Or that's a coin. That's not a bar.
It's not. There's a couple different designs. I don't know. So look. So you asked about monetary policy. I mean, the dollar dropping.
Why is gold near all-time highs?
Yeah, I mean, dollar dropping means it takes more dollars to buy gold. That's the easiest answer that you can give. Gold is an inflation hedge. Well, inflation's coming down, so there's the opposite reason. Right. That's not what it is. I think it's a currency story more than anything else, and it's an expectation of further easing.
The dollar is going to be a story too. You mentioned it earlier. The dollar dropping helps multinational companies when they convert back to U.S. dollars, and companies like Apple, they report in U.S. dollars. It boosts their earnings. It boosts their EPS, their net income, their revenues. So that was a headwind in 23. Could be a tailwind this time. I don't know. I mean, I'll let you know when I know, but it's good for big companies like Apple.
Right. Which is good for earnings. Can we translate that?
Earnings. Good for earnings.
Earnings.
That's right.
Yeah.
Because if the dollar gets stronger, if you sell, I don't want to go through it again.
Yeah, we've done that. We could do a show on, you could be Europe and I could be America. Hey, we can even throw tariffs on and have a little battle.
Yes. Are we done? Is that it?
I was just going to ask if somebody wants to track the dollar, what's a good ETF that they can use?
I
like the UUP. It's an investor dollar index.
Is that an ETN or an ETF?
Oh, it might be an ETN. You're right. Well, it's a fund that can track that. You might be right. How do you say that? Just pull it up on the Bloomberg, see what it says.
Yeah. UUP. But for tracking purposes, I think that's they must have had a distribution or something. You see the big gap in the chart?
It says the Invesco DB US Dollar Index Bullish Fund is an exchange-traded fund.
Okay, there you go. UUP, right?
Yeah.
It's a weird chart, though, Jay. Look at that. Had that big gap down.
I see it. Yeah.
But they have done I'd have to know more about this one.
Yeah.
But I think your point is well taken. It's if you're kind of playing the home game and you want to see what the dollar's doing, this is a pretty good proxy. Just if you looked at this versus the dollar index, it'd be pretty close, I think.
Yeah. There you go.
But that's dollar down is, all right. So when we write the high probability option strategy, we write the updates. I always have this little section. What are you rooting for? Like if you're an equity investor, what are you rooting for? Well, obviously earnings estimates to continue going up, earnings to come in good, but you want the dollar down. You'd like interest rates down in case companies needs to go to the debt markets. The present value of future cash flows is worth more at lower interest rates. Like that's sort of if we were to say Goldilocks, besides the obvious of the economy, like dollar down, interest rates down, you kind of like that.
Markets like that.
They like it.
Yeah.
All right. Mildly more optimistic for the markets than the New York Giants, football Giants season, but that would be a whole hour of despair.
You should feel relieved. Like it's over. Like it's so. There's nothing like. Don't worry. It's over. Like you don't have to get excited about the weekend. You can watch but don't worry. You're not like, oh, we're really gonna miss out. We're gonna miss out. The Giants are gonna be another disappointment. I love that. I'm sure you've seen this, right? Since Daniel Jones's, monster contract, he's thrown more touchdown passes to the other team, more pick sixes than touchdowns since his.
That's not even possible. Come on.
It's 100% true. It is 100% true. He's thrown like 3 touchdowns and he's thrown like 5 pick six or something like that. It's 100% true. Look it up. Ask the Google machine. Ask your Instagram feed. It's really a disaster.
How would I ask my Instagram feed? I'm not on Instagram, but how would I ask it?
Well, that's true. You're old school. Why don't you ask your AI? But anyway, I would tell you, so look, the Giants are giving you a break. Don't worry, we're it's like a weight. You just put it down. It's over.
I agree. I mean, I'm excited for the draft already. I've been
we're counting on the draft.
watch a little bit of Speaking of, and I didn't. That seems unfathomable that he could have thrown an interception where the opposing team scored more of those than touchdowns. That is crazy.
Yeah,
I did. So I was at a playoff game. Kurt Warner, when he was a quarterback for the Arizona Cardinals, and now Hall of Famer. He had more touchdowns than incompletions that game. He was 29 of 33, so that's 4 incompletions, right? 9, 10, 11, 12, 13. Yeah, 4. 5 touchdowns, no interceptions. Threw for, I don't know, like 450 yards, 500 yards, something like that. He was pretty good.
We don't have one of those now.
All right, Let's go to recommendations, Jay. Anything this week?
Let's see. I saw Beetlejuice.
Oh, yeah. How was that? Good as the first one?
Yes. And it was, I would like to go see it again. It was good. And it was very entertaining. Definitely I would see it again. So if you're even mildly entertained by Beetlejuice, you should go see that if you have not seen it yet. It was good.
Okay. I continue to. I haven't watched the new one, but Bad Monkey with Vince Vaughn.
I'm almost caught up. Yeah. So I think that's continuing to go good. Yep.
Randomly the other day, it was before I went to bed. I started watching it. The Jackal, 1990s movie where Richard Gere pretends to be an Irishman with a.
Yeah, I remember that one.
Yeah, and what's his name? Bruce Willis was in there too.
Yeah.
It actually was pretty entertaining, but the accent threw me off. I'm like, they couldn't have gotten an Irish guy just to do this? Well, I guess it doesn't get made without Richard Gere.
Yeah.
All right.
I just sent you the quote there. I'll read it to you. Since signing a 4-year, $160 million contract with the Giants during the 2023 off seasons, Jones has only won one game as a starting quarterback. He has thrown only 2 touchdown passes, and he has thrown 3 interceptions that were returned for a touchdown. So 3 pick sixes versus 2 touchdowns. That's our quarterback.
It's brutal.
Write that down. You know what I watched, and these are old, and these are like mini movies for television. So when you're streaming them, they're only like an hour and a half long. It's Tom Selleck has a series of movies called Jesse Stone is the name of the character, and he's basically kind of a troubled cop who goes to work in Paradise, Massachusetts, which is supposed to be like a northern little fishing town. They're not bad. They're real light watching, easy to watch them, but there's like 8 of them, And they're like these little mini movies, and you got to watch them. You don't have to watch them in order. I did not find the right order. If you Google the order, but like from 06, 05 to 2016, he's been putting these movies out. So if you haven't watched the Jesse Stones, think about that one.
Jesse Stone. What is that on again?
Prime.
On Prime. Okay. All right.
So just finished those.
Okay.
The last one got nominated for some awards. So, but that was 2016. It was a while ago. He is thinking about bringing it back. We'll see.
Well, Blue Bloods is ending, right?
That's right. Blue Bloods is ending, and I think he'll rotate to this Jesse Stone. That's the rumor.
Between his Magnum PI, Sirius, and Blue Bloods, you think he has an alarm anytime he gets a residual payment? It just kind of keeps going off
because constantly going.
Yeah, these things are on everywhere. You know,
good for him.
Yeah, good for him.
Solid guy. Seems like a solid guy. I'm sure there's negative press about everybody out there, but people seem to like Tom Selleck.
You know, I have as a Yankee fan, I will wear National League baseball caps. I do fitted baseball caps, but I won't wear another American League hat except for the Tom Selleck, the Magnum PI exception. I can wear a Tigers hat. That's okay. You'll do that. It's the Magnum exception. So that's fine. All right, we're done here. We talked about everything we're going to talk about. That's it. We're out. We'll come back next week. We promise. All right, we'll get longer next time. See you, everyone. Bye.